All right, as promised, we are with Jeff Hirsch of the Stock Traders Almanac. Here it is. I told you he was coming in 10 minutes. We got so excited, we brought him on now.
Thanks.
We got some nuggets for you. All right, Jeff, when was the last time you saw an October like this, and what does it mean for what's coming up over the next couple of months?
If we stay at this level, there's never been an October like this. This is on pace to be the biggest gaining October ever since 1896. And the thing that we did, we took all the top 20 October since 1950, and 17 to 20 of those, not 100% of them, have seen gains over the next 3 months, averaging 6% from November, December, and January, all 3 months together.
So 17 out of the past 20 times. All right, which, if I could do the math, works out to about 85% of the time.
And 850.
I did that in my head.
Quick, very quick.
All right, you tend to get an average return of 6%.
That's right.
Over the next 3 months.
It's a good sign here. A strong October. We killed another bear. October, this will be if the bottom actually occurred October 3rd, which I think it did, this will be the 12th post-World War II bear market that has turned the tide in October.
Okay, you've got 4 key indicators.
Yep.
Psychology,
Yep.
fundamentals, technicals, and then seasonality.
Right.
All right, let's start with the first 3. We'll come back and do seasonality after the commercial break. We got a lot to talk about.
Okay.
Run us through psychology, fundamentals, technicals. Just give us a lay of the land.
Sure. Well, our friends over at Investors Intelligence track the bullish advisors, bearish advisors percent, and that's bottomed recently after being lower than it's been in over a year.
And when you say bulls, bears, bottoms, what does that mean?
It's mean that there was very few bulls and a lot of bears, and now that's starting to turn.
So
usually
everyone
that happens
was on one side.
It's a contrary indicator,
yeah.
Like the put-call ratio that I track. A lot of people use the daily. I look at the weekly put-call ratio, which didn't get as extreme as it does in real major bear market bottoms. But back in August, we were up in the high 85% of puts versus calls out there when we had the low point in August. So there's a big technical move that we've seen here as well.
And what about the VIX? Does that play into your calcs in any way?
It does, and that's gotten much lower. It's really turning around, showing a lot of fear coming out of the market as we've broken out above the range. And I think that, along with the put call and other sentiment indicators, is indicating we've got some upside here.
Okay, moving on. Talk to me about some of the fundamentals.
Well, the funny thing is that the consumer confidence number was negative. It seems,
right.
But the retail was up. It seems as though they were taking a survey, calling everyone who was sitting at home, not the people who are on their cell phones at the mall. So,
actually buying.
Exactly. GDP was good. We've got some good earnings, a couple of disappointments, but on the whole, there's some positive things going on there, except the unemployment rate is still high, housing's still kind of troubled. So there's
and as you run the numbers, whether it's back to 1896 or World War II, however it is you do it, have you ever seen a situation where you have that many sort of split or divergent indicators?
Yeah, this is not uncommon. I think, after coming down as much as we did, 16.8% in the Dow, almost 30% of the Russell 2000 during the worst 6 months as we had forecasted, I think it's seeing the turn of the tide, that turnaround Tuesday we had on October 4th, sort of surpasses all the sort of noise between the conflicting indicators, and I think, we've got some positive.
Okay, so you see a turn fundamentally. Finally, let's talk here about technicals. Mm-hmm. Talk to me about some of the things, bear market bottoms. You cranked some numbers there, right? About, what is it, from 12 to 28% over 2 to 4 months?
The waterfall decline. Now, here's what we've seen. After we've seen quick declines of 28% over 2 to 4 months, we've seen that whole waterfall get reclaimed.
And that's what we saw.
That's what we had from July 21st down to the October 3rd bottom. We had that kind of a drop there, about 16.8%. So what we've seen is that whole waterfall level reclaimed in 3 to 8 months. I think it's going to happen sooner this time. I said we're going to get back to 12.7 by January 2012. Looks like we could even get there by Christmas or even Thanksgiving with the market we had yesterday.
What other technical indicators jump out at you?
We crossed above the 200-day moving average. We've broken out of the range.
Which is the long-term trend.
One. We already blew through the 50-day. Takes some time for the 50-day to get up to the 200, but we used our MACD indicator, developed by the great Jerry Appel, that gives us a little momentum shift. We had that signal come out on October 6th, a couple days after the low.
Sounds like you would be a buyer in here.
We have been. We sold our bond positions that we had. We used some of the ETFs and some of the short mutual funds that we had our subscribers in on the 6th, the 7th the next day, and we're getting people in.
All right, welcome back to the floor of the New York Stock Exchange, where we are joined by Jeff Hirsch, one of the co-authors of the Stock Traders Almanac. It's good to have you down here. Now, Lisa, if I understand things correctly, Jeff kind of inspired you to run some numbers of your own. Is that right?
That's absolutely right. I'm a big fan of the Stock Traders Almanac, and here's what we learned. One of the interesting tidbits you can pull up in the Almanac. Well, Look, we're almost at the end of the month, so I took a look at what typically happens on the first day of the month, right? And over the last 14 years, the Dow has gained more points on the first trading day of the month than on all other days combined. So on average, it sees gains of almost 36 points, while the total return on all other trading days averages out to a loss of about 0.3%.
Right.
That's why we got to read the Stock Traders Almanac, because it's chock full of interesting factoids like that. What can we?
You got to be careful of November 1st, though, because the last 6 years has been down 4 times.
Now, I actually have the 2012 copy of the Stock Traders Almanac, and I happen to see that one there for November 1st. So what else can we expect on the first day of a trading month, Jeff?
Well, after this big rally yesterday, I think we're going to be soft for a couple of days. But the end of the week is generally more bullish, and I expect to see continued gains. But I'm looking for any soft patch for people to get a little longer. If they haven't got long already, or they added positions going into the big end of the year best 3 months rally that we're expecting.
Jeff, sorry about that, Adam.
No, you jump in here, Lisa.
I'm going to jump in just on commodities as well, because we talk about stocks quite a bit, but you also have almanacs on commodities.
Sure.
Let's talk about that. I saw that. I think I'm supposed to be getting long corn right now.
Yeah, you want to get into the harvest lows. We've also got a big trade in the S&P futures that goes from Halloween to New Year's, and then the euro, which interestingly has a seasonal move the last couple of months of the year, Halloween to Christmas move that you can take advantage of. And then I see copper moving up a bit today. That was something we used to call the top back in April, May. Copper topped out a little bit earlier. It looks like copper's on the move too. That usually picks up in December, maybe going a little bit earlier this year as the economy's picking up, and it bottomed a little bit earlier. So that usually begins to take off. It makes a bottom in about December when construction's really low.
Now, Jeff, there's also a first half of the year versus second half of the year seasonality you've identified. What's that?
You mean the best 6 months versus the worst 6 months? It actually doesn't break down calendar-wise. It's the best 6 months, November through April, versus the worst 6 months, May through October. Now this year was perfect. We had 5 months in a row, May through September, all down, and we made nice gains. The last best 6 months. It had been off kilter during the financial crisis, but it seems to be backfiring.
And how do the numbers work out? That best 6 months, November through May? Versus the other 6 months?
You get about a 7% gain, 7.3% gain in the best 6 months, and like 0.3 in the worst 6 months on the Dow.
That's significant. Talk to me also about the presidential cycle, because we're in the third year right now.
Yeah, if this year continues on pace that it is, I figured we'd have about a 5 to 10% gain. Looks like we're on track for that. This would be the continuing the record of no losses in pre-election years since 1939.
Never.
72 years.
And then what happens in the presidential election year next year, 2012?
Presidential election year is good. Depends a little bit on the strength of the incumbent president, but usually have some gains in the beginning of the year. The first 5 months of the president's strong, but there's only been 2 losses in the last 7 months of election years. One was 08 when everything fell apart, and one was when we had the undecided election in 2000.
All right, Jeff Hirsch, it is a pleasure to have you down here. Lots of facts and figures.